On January 12, 2026, the silver market crossed a threshold that financial historians will likely revisit for decades. The spot price surged past $85 per ounce in a single session, but the number itself is merely a symptom. What matters is not the height of the move, but the violence with which it occurred and the structural fractures it revealed. Markets do not gap vertically without reason. When price discovery becomes disjointed, when the paper contracts traded in futures exchanges begin to drift away from the physical reality they are meant to represent, the system enters a terminal phase. This is not the first time such a divergence has appeared, and it will not be the last. But the specific conditions present today suggest that the mechanism designed to suppress volatility and maintain confidence in fiat pricing is beginning to fail. The architecture of modern commodity markets was built on a simple premise. Derivatives, futures contracts, and leveraged instruments were introduced to provide liquidity and stabilize prices by allowing producers and consumers to hedge risk. Over time, however, these instruments became tools of price control. The volume of paper contracts traded on exchanges like the COMEX far exceeds the physical inventory available for delivery. In a functioning market, this is sustainable because most contracts are settled in cash, not metal. The system relies on the assumption that only a small percentage of contract holders will ever demand physical delivery. But when that assumption breaks, when the holders of paper contracts begin to insist on taking possession of the underlying asset, the entire structure becomes unstable. This is not speculation, it is mechanical. The ratio of paper claims to physical ounces has been rising for years, and the inventory held in approved warehouses has been falling. The mathematics of this situation are binary. Either the price rises to discourage delivery, or the system defaults. History offers clear precedents. In 1980, the Hunt brothers attempted to corner the silver market by taking delivery on futures contracts. The price surged to $50 per ounce before the exchanges changed the rules mid-game, raising margin requirements and restricting purchases. The market collapsed, the Hunts were ruined, and the lesson was embedded into the regulatory framework. Concentrated positions that threaten the stability of the clearing system will not be tolerated. But the current situation is fundamentally different. The demand is not coming from a small group of speculators. It is coming from entire industries and sovereign nations. China, the world's largest manufacturer of solar panels and electric vehicles, consumes more silver than any other nation. The metal is not optional for them. It is a material input for their economic strategy. They cannot be margin called. They cannot be bankrupted. They will pay whatever price is necessary to secure supply. The divergence between the Shanghai Gold Exchange and the COMEX is the clearest evidence that a dual pricing regime has emerged. On the same day that New York reported a spot price of $85, Shanghai closed at $93. The gap is not a temporary anomaly. It is a structural dislocation. Arbitrage traders are already exploiting it, buying metal in the West and shipping it east. This creates a drain on Western inventories that accelerates with each passing day. The more the price rises in Shanghai, the greater the incentive to export from London and New York. The more metal that leaves, the tighter the physical market becomes. This is a feedback loop, not a cycle. It does not self-correct. It amplifies until equilibrium is restored, and equilibrium in this case means price convergence. The paper price in New York must rise to meet the physical price in Shanghai, or the Western vaults will empty entirely. But even as the macro forces push the paper price higher, a second crisis is unfolding at the retail level. Major bullion dealers across the United States are reporting unprecedented premiums and delivery delays. The premium, the markup over spot price that dealers charge to cover minting and distribution costs, has exploded to between $8 and $10 per ounce. This is not a temporary spike. It reflects a collapse in available inventory. Private mints, the entities that transform industrial bars into coins and rounds, are quoting delivery windows of 8 weeks or longer. This is not because they lack the capacity to produce. It is because they cannot source the raw silver. The supply chain that connects miners to refiners, to mints, to dealers has fractured. Each link in the chain is reporting the same condition. There is no buffer. There is no slack. The system was designed to operate on just-in-time inventory management, and that design has failed under stress. The statement from a senior bullion executive that nobody has any silver is not hyperbole. It is an admission that the retail market has entered a state of allocation. Buyers are no longer purchasing at a price. They are competing for access. When premiums rise to $30 per ounce, as some dealers are now predicting, the distinction between spot price and street price becomes meaningless. A paper contract on the COMEX may settle at $85, but the cost to acquire a physical ounce in the United States will be $115. This bifurcation is evidence that the price discovery mechanism has broken. The futures market is no longer leading, it is lagging. The physical market is setting the real price, and the paper market is simply catching up in delayed increments. This is not the first time a commodity market has experienced such a disconnect. In the lead-up to the 2008 financial crisis, the London Bullion Market Association faced a quiet crisis in gold deliveries. Spreads between physical and paper widened as institutional buyers began demanding metal instead of cash settlements. The crisis was managed through coordinated central bank leasing programs that released gold into the market to relieve pressure. But silver is different. Central banks hold negligible amounts of silver compared to gold. There is no emergency stockpile to deploy. The only mechanism available to suppress price is to flood the futures market with new contracts. But that strategy requires willing sellers on the other side. If buyers insist on delivery, the contracts become liabilities, not tools. The mathematics of this situation are unforgiving. The COMEX reported total silver inventory of approximately 30 million ounces in December 2025. Daily industrial consumption in China alone exceeds 2 million ounces. If even a small percentage of futures contracts standing for delivery were to demand physical metal, the available inventory would be exhausted in a matter of weeks. The clearinghouses understand this. The banks that are short these contracts understand this. The only question is whether they can engineer a price crash severe enough to shake out the buyers before the physical shortage becomes undeniable. The bear trap executed on January 9th, when the price was driven down to $74, was an attempt to do exactly that. It succeeded in flushing out over-leveraged retail traders, but it failed to deter the industrial and sovereign buyers. They absorbed the dips and continued accumulating. The price recovered in a V-shaped reversal and accelerated higher. This tells us that the demand is inelastic. It will not respond to price signals in the way that speculative demand does. Inelastic demand is the death sentence for a suppressed market. In a normal commodity cycle, when prices rise, demand falls, and supply increases. Producers ramp up output, consumers reduce consumption, and equilibrium is restored. But silver is not a normal commodity. It is consumed in applications where there is no substitute. A solar panel manufacturer cannot replace silver with copper or aluminum without redesigning the entire product and sacrificing efficiency. An electronics producer cannot eliminate silver from circuit boards without accepting inferior performance. The substitution barrier is high, and in many cases, it is absolute. This means that as the price rises, industrial buyers do not reduce their orders. They simply pay more. They have no choice. Their alternative is to shut down production, which would cost them far more than the premium they are paying for the metal. The feedback loop between inelastic demand and declining inventory is what separates a bull market from a supply crisis. In a bull market, rising prices eventually attract enough new supply to satisfy demand and stabilize the system. In a supply crisis, rising prices do not bring new supply because the supply does not exist. Global silver mine production has been essentially flat for the past 5 years, despite significant price increases. The easy deposits have been exhausted. New discoveries are rare and expensive to develop. Recycling rates are insufficient to close the gap. The deficit between annual production and annual consumption has been growing for over a decade, and it has been filled by drawing down above-ground inventories. Those inventories are now critically low. When they are gone, the market will have to clear at a price high enough to destroy demand. That price is unknown, but it is almost certainly far higher than $93. The psychological impact of crossing $100 per ounce cannot be understated. Round numbers carry disproportionate weight in human perception. When silver breaches $100, it will trigger a wave of media coverage that will bring millions of retail investors into the market who are not currently paying attention. This is the awareness threshold. Most of the public still associates silver with its historical range of $15 to $30. The idea that it could trade above 100 is alien to them. When that threshold is crossed, it will reframe the entire narrative. Silver will transition from a niche commodity to a headline asset. The volume of searches, the number of new brokerage accounts opened, the inflow of capital from investors who previously dismissed the metal as irrelevant will create a surge in demand that the physical market cannot absorb. This is not a prediction. It is a pattern that has repeated across every major commodity breakout in modern history. Oil in 2008, gold in 2011, Bitcoin in 2021. The sequence is always the same. A structural shift occurs quietly. A small group of informed participants accumulates. The price breaks a psychological level. The media amplifies the story. The public rushes in. The price goes parabolic. Then, eventually, it corrects. But the correction never brings the price back to where it started, because the structural change is permanent. The difference with silver is that the structural change is not financial. It is physical. The West is running out of metal. The East is accumulating it. This is not a trade. It is a transfer. The arbitrage between New York and Shanghai is not a temporary inefficiency that high-frequency algorithms will eliminate. It is the visible manifestation of a geopolitical rebalancing. For decades, the West controlled the pricing of commodities through its financial markets. The futures exchanges in London, New York, and Chicago were the global benchmarks. But when the physical metal flows in one direction and the price diverges by $8 per ounce, the benchmark has lost its authority. The price is now being set by the buyer with the deepest need and the longest time horizon. That buyer is not a hedge fund. It is a nation state with industrial policy objectives that span decades. The end game for this situation is binary. Either the paper price rises to meet the physical price and the arbitrage closes, or the paper market breaks entirely and contracts are settled in cash at distressed prices, while the physical market trades at a massive premium. Both outcomes result in the same conclusion for the individual trying to acquire metal. The cost will be higher than it is today. The premiums being quoted by dealers, $8 to $10 now with the potential to reach $30, are not gouging. They are the market's way of rationing scarce supply. When supply is abundant, premiums are low because competition between dealers drives margins down. When supply is scarce, premiums explode because the dealer who has metal can charge whatever the buyer is willing to pay. This is not a failure of the market. It is the market functioning exactly as designed under conditions of scarcity. The 8-week delivery delay is the final confirmation that the system is stressed beyond its capacity. A delay of that length indicates that the mints are operating on a backlog, accepting orders they cannot immediately fill in the hope that new supply will arrive before the delivery date. This is a gamble. If the supply does not arrive, the mint defaults. The buyer is left holding a contract for metal that does not exist. At that point, the only recourse is a refund, but a refund in depreciating currency does not compensate for the opportunity cost of the metal that was never delivered. The longer the delays stretch, the more the physical market resembles a futures market, except without the legal protections or liquidity of an exchange-traded contract. This is the worst of both worlds. The question that remains is whether the current acceleration is the beginning of the true supply crisis or merely a prelude. The velocity of the move suggests that large participants are repositioning urgently. The lack of selling pressure at the highs suggests that holders of physical metal are not interested in exiting their positions. The widening of the Shanghai premium suggests that the East is willing to pay significantly more than the West to secure supply. All of these signals point in the same direction. The system is not going to return to the range-bound stability of the past decade. Something fundamental has shifted. The only uncertainty is how quickly the shift will complete and how violent the final repricing will be. History teaches us that systems under this kind of stress do not adjust gradually. They break suddenly. The transition from manageable tension to outright crisis is not linear. It is exponential. And once it begins, it cannot be reversed by policy or rhetoric. It can only be resolved by price. The mechanisms that govern commodity markets are not designed to prevent crises. They are designed to delay them long enough for participants to reposition. The futures exchanges, the clearinghouses, the margin requirements, the position limits, all of these structures exist to manage risk in the aggregate, not to eliminate it. When stress accumulates beyond a certain threshold, the system does not absorb it. It redirects it. The question is never whether a market will break under sufficient pressure. The question is only where the break will occur and who will bear the loss. In the case of silver, the break is occurring simultaneously across multiple layers. The paper contracts are diverging from physical reality. The Western vaults are draining to the east. The retail supply chain is seizing. These are not independent events. They are symptoms of the same underlying failure, which is that the quantity of claims on silver far exceeds the quantity of silver available to satisfy those claims. This is not a new phenomenon. It is the same dynamic that has destroyed every fractional reserve system in history. The Roman Empire debased its currency by reducing the silver content of the denarius until confidence collapsed and trade reverted to barter. The French assignats of the 1790s were backed by confiscated land, but the volume of paper issued exceeded the value of the collateral, and the currency became worthless within 5 years. The Weimar Republic printed marks to service war debts until a loaf of bread cost billions. The pattern is always the same. A government or institution issues a claim on a resource. The claim is initially redeemable. Over time, more claims are issued than there are resources to back them. Confidence is maintained as long as redemption is rare. But when redemption accelerates, the gap between claims and resources becomes visible. Panic follows. The system collapses. What makes the current situation remarkable is not that it is happening. It is that so many participants still believe it will not happen to them. The belief that modern financial engineering has solved the problems that plagued previous systems is deeply embedded in institutional thinking. Central banks operate under the assumption that liquidity can be managed through interest rate policy and quantitative easing. Exchanges operate under the assumption that circuit breakers and position limits can prevent disorderly markets. Governments operate under the assumption that strategic reserves and emergency powers can stabilize supply chains during disruptions. All of these assumptions rest on a single premise, which is that the interventions will be deployed before the crisis reaches a point of no return. But crises do not announce themselves with sufficient warning. They accumulate slowly and then accelerate suddenly. By the time the alarm is raised, the tools available to policymakers are no longer sufficient to contain the damage. The gap between recognition and response is where systems fail. The silver market is particularly vulnerable to this dynamic because it exists at the intersection of industrial necessity and financial speculation. Unlike gold, which is primarily a monetary asset held for its store of value properties, silver is consumed. It is used in products that are then sold, discarded, or recycled at rates far below the original input. This means that every year, a significant percentage of global silver production is effectively destroyed. It does not return to the market. It ends up in landfills, dispersed across millions of consumer electronics and solar panels that will never be economically viable to reclaim. The deficit between mine production and industrial consumption has been papered over by drawing down inventories, but those inventories are finite. When they are exhausted, the market will have to clear at a price that either destroys industrial demand or incentivizes new mine production at a scale that is currently not occurring. Neither outcome is painless. The historical precedent that most closely resembles the current situation is the oil crisis of 1973. The disruption was triggered by geopolitical events, but the underlying cause was structural. Global oil production had been growing steadily for decades, but the rate of growth was beginning to slow. Demand, however, continued to accelerate. When the Arab oil embargo restricted supply, the market did not adjust gradually. It spiked violently. Prices quadrupled in a matter of months. Gasoline rationing was implemented across the United States. The crisis ended not because new supply was discovered immediately, but because demand was destroyed through a severe economic recession. The lesson from 1973 is that commodity shortages do not resolve themselves through market mechanisms alone. They resolve through demand destruction, which is another way of saying economic contraction. The current trajectory of the silver market suggests that a similar outcome is possible. If industrial demand for silver continues to grow at the rate required to meet global solar and electric vehicle production targets, and if mine supply remains flat or declines, the deficit will widen until the price rises high enough to either halt new production or force a redesign of the technologies that depend on silver. The problem is that redesigning industrial processes takes years. A solar panel manufacturer cannot pivot to a silver-free design in response to a price spike. They are locked into their current technology by capital investments, supply contracts, and regulatory certifications. This means that in the short term, they will pay whatever price is necessary to keep production running. But if the price remains elevated for long enough, entire industries will become uneconomical. Factories will close, projects will be canceled. The energy transition that governments around the world are attempting to engineer will stall. This is the hidden cost of resource scarcity. It is not just that prices rise, it is that the economic activities dependent on those resources become impossible to sustain. The Western economies that have offshored manufacturing and assumed that global supply chains would remain stable are now discovering that supply chains are only stable when there is surplus capacity. When every link in the chain is operating at maximum utilization, a disruption anywhere cascades everywhere. The shortage of silver is not occurring in isolation. It is occurring alongside shortages of lithium, cobalt, rare earth elements, and semiconductor-grade silicon. These are not coincidences. They are the result of decades of underinvestment in resource extraction, combined with a sudden surge in demand driven by the electrification and digitization of the global economy. The system is being asked to supply more than it can produce, and the gap is widening. The Shanghai Premium is the market's way of signaling that the center of gravity has shifted. For the past century, commodities flowed from resource-rich regions to manufacturing hubs in the West. The West controlled the pricing, the financing, and the distribution. But the manufacturing base has moved. China now produces more solar panels, batteries, and electric vehicles than the rest of the world combined. They are not producing these goods for export alone. They are building domestic infrastructure and securing their energy independence. This requires resource security. It requires control over the supply chains that feed their industrial base. The willingness to pay a premium for physical silver is not irrational. It is strategic. They are outbidding the West because they understand that the nation that controls the resources controls the future. The West, meanwhile, is trapped in a contradiction. Policymakers speak of reshoring manufacturing and reducing dependence on foreign supply chains, but they have not secured the resources necessary to make that transition possible. The mines are not being built, the refineries are not being expanded, the stockpiles are not being replenished. Instead, the assumption seems to be that markets will solve the problem through price signals. But price signals only work if there is elastic supply, and the supply of silver is not elastic. It takes 7 to 10 years to bring a new mine online. And even then, most silver is produced as a byproduct of copper, lead, and zinc mining. If those base metals are not economically viable to extract, the silver does not get produced, regardless of the price. The retail market is where the consequences of this structural failure are becoming most visible to the public. The 8-week delivery delays are not a temporary inconvenience. They are an indication that the buffer between production and consumption has disappeared. When the mints cannot source raw silver, it means the refiners cannot source doré bars. When the refiners cannot source doré bars, it means the miners are not producing surplus output. The entire chain is operating hand to mouth. The premiums being charged by dealers are not arbitrary markups. They are the market clearing price for scarce supply. And if the executive's prediction that premiums could reach $30 per ounce is correct, it means the effective price of silver for retail buyers could exceed $115, while the paper price on the COMEX remains anchored below $90. This is a divergence that cannot persist indefinitely. Either the paper price will rise to meet the physical price, or the paper market will lose all credibility and cease to function as a pricing mechanism. The endgame scenarios are limited. In the optimistic case, the price rise incentivizes a wave of new mine development and increased recycling efforts. Supply gradually catches up to demand over a period of years. The crisis is resolved without systemic collapse. But this requires capital investment, regulatory approval, and geopolitical stability, none of which can be assumed. In the pessimistic case, the shortfall becomes acute before new supply comes online. Industrial buyers are forced to compete directly with investors and sovereign nations for available inventory. Prices spiral upward. Governments intervene with export restrictions and strategic reserve releases. The market fragments into regional blocks with different prices and allocation systems. Trade in physical metal becomes politicized. The final outcome in this scenario is not a market price, but a controlled distribution system, which is how all severe shortages are ultimately managed. The silver market is not unique in facing these pressures, but it is among the first to reach a breaking point because it is small. The total value of all the silver ever mined is a fraction of the market capitalization of a single large technology company. It does not take much capital to move the market. It does not take much disruption to create a shortage. This makes silver a leading indicator. What is happening now in silver will eventually happen in other critical materials. The same dynamics of inelastic demand, finite supply, and geopolitical competition will play out across lithium, cobalt, and rare earths. The difference is that those markets are larger and more politically sensitive. When they break, the consequences will be more severe. The calm conclusion is this: the system is not designed to handle the transition it is being asked to make. The resource base is insufficient. The infrastructure is inadequate. The investment has not occurred. And the time required to correct these deficiencies is measured in decades, not quarters. The participants who recognize this earliest will reposition accordingly. They will secure physical assets while they are still available. They will diversify away from paper claims. They will accept that the stability of the past will not return. The participants who continue to believe that central banks and governments will engineer a painless adjustment will be caught exposed when the adjustment occurs violently. History does not offer examples of resource transitions that proceeded smoothly. It offers examples of systems that adapted through crisis. The current trajectory suggests that this transition will follow the historical pattern. The only question is whether the recognition will come early enough to allow for an orderly response, or whether it will come too late to prevent systemic disruption. The window for the former is closing.